Kia ora, how you going? How is everyone? Hope you're having a good day. I'm Willie Isles and this is the Budget Investor, so welcome back. Now today I thought we've had a lot of noise this week from the government around property investors. So I thought there were two sort of major announcements that impact property investment announced earlier this week. So I thought I'd jump into the first one of these being the Brightline Tax and maybe give you a quick rundown of what we had before, what we have now, and the impacts that might have on you if you're looking to buy a property in the near future. So, first of all, I thought it might help if we just go quickly through what is the Brightline test or Brightline Tax, just to help you frame the discussion later on. So the Brightline Tax is basically it's New Zealand's capital gain tax on our housing market, and then it's got a few nuanced rules around that. So one of the first things is it's predominantly aimed around short-term buying and selling. So it's not really there to tax people holding property for a long time. It's not there to tax the family home. So it is actually looking at, how can we implement a capital gains tax on secondary, 2, 3, 4 houses or houses that aren't used as your place of living. And I think really, it was to help. The IRD already have a bunch of tax rules aimed at other sort of property transactions, but they brought this in sort of just to help with the administration in taxing these people who are involved in these short-term property transactions. I mean, down here I've got a few examples, developing, trading and flipping. These are already taxable activities and should be paying tax under the current IRD rules, but they sort of brought in the Brightline Tax just to make things like a bit more crystal clear on, so that to make sure that no one gets through any other sort of weird loopholes that they're not meant to. So now that you know what the Brightline Tax is, I thought I'd just quickly run you through how to sort of determine if you might need to pay Brightline Tax or not. So actually, in terms of tax law, it's fairly straightforward. There's a few simple rules, and if you meet the rules, you pay tax. If you don't, you don't have to pay tax. So to start off with, we'll just start at the start here. There's sort of three things that you first look at whether or not you'll have to pay any Brightline tax. So the first thing might be is, did you inherit the property or not? So inheritance. And then the second thing you might look at is, have you lived in the property yourself? Have you been an owner-occupier of the house the whole time that you've had it? So owner-occupied. And the third thing you'll just look at is, when did you purchase this property? Was it before the 29th of March 2018? So if the answer to any of these, so did you inherit the house? Did you inherit the house? Were you an owner-occupier, or did you buy it before 29 March 2018? The answer is yes to any of these, then you don't need to pay Brightline tax. If the answer is no, then we will need to look at a few more rules. So no, we need to look at a couple more rules to see what Brightline tax we might have to pay. So the first one will be is, did you purchase this property before the 27th of March 2020? And lastly, the last rule is, is the house that you're buying, is it a new build or is it an existing house? So now we'll go through these. So if we bought it before 27th of March 2020, or we bought the house as a new build, so it doesn't matter when, then we will be under what is known as the 5-year Brightline tax. which has its own set of rules around determining, if you have to pay tax or not. So this is yes up here. We've bought before 27th of March or it's a new build. If we're a no, then what we fall under is the new 10-year Brightline tax rules. So since the old 5-year rules have been around for a while, I'll just quickly run through these. There's plenty of education and documentation out there on how to exactly apply the rules. We'll just give it a quick run through and then we'll jump into the new 10-year rules because less people will be familiar with these. So let's quickly go through what the 5-year Brightline tax, what the tax rules are and what it would look like. So to start off with, under the old rules, basically you were subject to Brightline tax if this was not your family home, as we've been through, and if you used it for a rental property or whatever, it was maybe your second or third home, and it wasn't your main home for more than 50% of the time. So that's the first thing. So, and this is really the main part, the main crux of it. So if 50% of the time it wasn't your main home, then you had to pay Brightline tax. And what you would do is when you sold the house, you would just recognise that gain that you got in your income tax return, and then you would pay tax on that. And there was a little bit of how do we determine what is the main home? And there was another little rule in there saying that you had to, when you're living in the house, you have to be using at least 50% of your personal space plus shared spaces. So we'll just call this 50% of space used. So in that sort of example, if you had a house and you had a little granny flat and that took up 20% of the space, and then you were renting out the rest of the house and that was 80% of the time, what you would find is you're not actually meeting the main home rule. So therefore it would be considered a investment property and subject to Brightline tax. So that was the old rule. And I mean, if we want, we can go through a quick example of what that looks like in reality. So we might have bought a house back in, sort of mid 2018. We've owned this property for 4 years. So 4 years. And we sell it exactly 4 years later. Now, applying that 50% rule, if we had used that house for as our main home, so main home for more than 2 years, then there would be no Brightline tax. But if we had used it for 2 years as a rental property, then we would have Brightline tax. So this one, no Brightline tax. This one, it would equal Brightline tax. So what we sort of ended up with under the old rule is a bit of a lopsided arrangement depending on how you'd use the house. So the tax you were paying was actually dependent on what the majority of the house was used for. The tax wasn't necessarily aligned in a direct proportion to the use of that house. So the new rules are aiming to address that, so we'll get into them and we'll see the differences in how the new 10-year rules are applied. Okay, so let's look at the 10-year rules, and we'll look at the first one, and it's kind of a 10-year rule, but not a 10-year rule. And it's the first question you got to ask is it a new build? And basically what the government wants to do is it wants to incentivize new buildings being built. So what they've said is, hey, look, if it's a new build, you're not subject to the 10-year Brightline test, the Brightline tax. If you've got a new build, it actually just falls under the 5-year test. So since it's a much shorter period, they're incentivizing people to build new houses and basically they're not going to be subject to Brightline Tax for the same length of time that someone purchasing a existing house would be. So the other type of property that we want to look at now is, like we've looked at new builds. Now what happens if we're purchasing an existing house? So the rules are slightly different here. And if we're purchasing an existing house, we actually look at the time that that house has been used for its different types of uses, and that's how we determine how much Brightline tax it will have to pay. So let's take 4 years, the same length of time as we used in our 5-year example. And let's say of those 4 years, 2 years we spent living in it, so it was our own home. So 2 years, main home. And the other 2 years we had it rented out, so it was a rental again. So 2 years rental. Now, what we'd find is that the rules would say that we should be paying a capital gain tax based on the split here. So when it was your main home, you don't pay tax. When it was a rental, you do pay tax. So you calculate your capital gain, and then you exclude the number of years that it was your own home. So this is 50% of the time. So, and then you include the years that it was a rental. So it was 50% of it as well. So you would work out your gain, and then you would times it by 50%, and that's how much tax you would have to pay. So if we just change these numbers slightly around to give you a different example, if it was our main home for 1 year and it was a rental for 3 years, that means we'd have to pay tax on 3 years worth of the capital growth. So we'd take our capital gain and we'd times it by 75%, or 3/4, 3 out of the 4 years. And that's how much that we would have to pay the tax on. So this whole thing changes it to exclude the time that you were using it as your main home, as opposed to the 5-year rule, where it looked at what were you using it most for. So in this example, we were mostly using it as a rental, so it would be taxed. But in the new rules, it would be fully taxed. Under the old rules, in the new rules, it would be taxed at 3/4, because for 1/4, you were using it as your own home. So let's go through another little scenario. So let's say that I buy a house for $1 million, and I buy a brand new house, so I've just bought it. Now what we'll find is that I will fall under the 5-year tax rules. So let's say I've owned this house for 4 years, and for the first couple of years, what's really interesting under these new rules is it says if you use it for short-term accommodations such as Airbnb or any of those other holiday home sites, that is also considered the same as a rental property. So say for a couple of years we used it as an Airbnb, and then we lived in the home for the last 2 years. We then go to sell the house and we get a nice big $1.2 million, but we also had to spend $100,000 on improving the house. So maybe we put in some double glazing and built a new deck and stuff like that. So a couple of really interesting things here is, one, the short-term rental is considered the same, or the short-term accommodation is considered the same as rental income and is taxable. And the other thing is that if you make any capital improvements, such as building new decks or new parts of the house or double glazing, you can actually take that off your capital gain at the end of the day. So to work out our capital gain, this one's slightly more complicated. We got the 1 million that we purchased it for, and we sold it for 1.2. So $200,000 increase. We take off the 100,000 that we actually spent on the house, and that leaves us with 100,000 left over. We then look at the use of the property, and we see that we used it for 2 years as a main home and then 2 years as short-term accommodation. So then we times the 100 by 2 out of 4, or half, and that'll give us $50,000. So like the previous example, that 50,000 is what we put into our income tax return, and then we work out how much tax we have to pay on that. So here's just like another little example of buying a new house. So say we buy new and we use this as a rental property, like we don't move in or live in it at all. And we have this house for 8 years, and then we decide it's time to sell the house. Now, because we bought new, Brightline tax would only apply if we sold it less than 5 years. So since we sold it after that at 8 years, there's no Brightline tax. So in this scenario, no Brightline tax. However, if we didn't buy new, so this is the key determining factor. If we bought an old house, then we would have to pay Brightline tax. So it would be a big fat yes to paying Brightline tax, because old would fall under 10 years. So that's the big key difference. New, 5 years, old, 10 years. So we've been through two examples of where you would have to pay Brightline tax under the new rules in sort of different scenarios. Now I thought I'd go through one of the little weird caveats of the change of use rule. So we're going to look at, in 2022, next year, we buy our first home, and this is our main home. And we live in it for the next 3 years until sort of 2025. Then we see our next sort of dream home, and we're like, I've just got to have that. So we buy our next house before we've sold our first one. Now, the market's kind of tough, and it takes us sort of 9 months to sell, a very long time. But eventually we do get it sold. Under the new change of use rules, anything less than 12 months won't be taxable. So to explain that a bit more, when she moved out of her first home into her second home and left the first home empty, there was a change of use. That first home was no longer her main home. So for the last 9 months, it was actually, it was a house that would be subject to Brightline tax. But there's a little sort of exclusion to say, if it's less than 12 months, then you won't have to pay Brightline tax. Now, for example, let's say it took her 15 months, like maybe she's got a rural lifestyle property and times are tough and it just takes a long time to sell. Because it's over the 12 months, she will actually have to pay Brightline tax on it. So again, you would look at the scenario and you would say, it's been a main home for 3 years, and then it was just a little over a year that it wasn't the main home. So then you have to pay tax on the gain of one of the 4 years. And so that's just how it works. So there's just a little thing to consider there that, if you're not using the house, but it's less than 12 months, it won't be subject to Brightline tax. And lastly, just to wrap it all up, we'll just go through a quick example under the 5-year rules for any properties that maybe you've already got. So in this scenario, we've bought a house before the 27th of March 21 when the new 10-year rules come in. We bought it for $500,000 and we've had the house for 4 years. And maybe for the first year we used that as our main home, then eventually we changed job or city or whatever and we had to get a new home. So we rented it out for the next 3 years. At that point we decided to sell and we got a nice $600,000 for it, which gives us $100,000 in capital gain. Now, since it's before the 27th of March, we actually fall under the old rules, which is looking at what for the majority of the time that you owned the house, what did you use it for? Now, since we only used it for 1 year as our main home, that means for 3 years we used it as an investment property, which would be subject to Brightline tax. So that means we would have to enter the full amount, the $100,000, into our income tax. So we don't do any further calculation working out the split. We just say it was mostly used for a rental or for making income. Therefore, you have to pay Brightline tax on it. So that's a quick run through of the new Brightline tax rules and how they've changed, what they were before and what they are now. So in summary, just going over the key points of what the changes were, we've seen an increase of the time from 5 years to 10 years. So what that means now is there's a longer period in which you might have to pay your tax back on. Overall, I don't think this really has that large of an impact. It will affect a small amount of people, but a lot of people who hold property for investment purposes do have it for more than 10 years. There would be some who have it between 5 and 10, but a lot have it more than 10. So a small amount of change, but not that much. So I don't think it's overall that bad. I mean, the way I look at it is it's not too bad. So it's at least on par. It gets a tip from me. It's not too big of a deal. The other change that they've made is, I guess, the model that determines how we pay the tax. So we've gone from a predominant use model to a change of use model. So we've gone from what was the property mainly used for, and that's how we decide if it's taxable or not. And then we've gone to a change of use model. So we're actually looking at the period that it was used for a taxable activity. So I think this change is actually very, very good. Before we had sort of a lopsided arrangement, which meant you could be overtaxed or you could get away with paying no tax depending on the predominant use. I don't think it was a blunt tool, didn't really work that well. I think the new change of use model is actually really good. It now means that you are actually paying tax for the correct period of which you were using it for a taxable activity. So this one gets gets an extra big tick. It's a much better model. I mean, yeah, sure, there's still wiggle room and ways that we can overall improve our Brightline tax test, but by and large, it's a pretty positive change. Nothing to get too upset about here. Like, yes, the period is longer, but it's not that big of a deal. But basically, the way we're calculating if you have to pay tax is a lot better than what it was before. It's a lot fairer, and yeah, it gets a big thumbs up from me. So that's it from me today. I hope you've enjoyed the video. As always, remember to give it, a like, share, leave some comments, leave some thoughts or questions that you might have on Brightline Tax. I'm sure you just line up and you can't wait to ask about more tax. But yeah, just put the word out there. If you don't want to, that's cool. That means you've already watched it to this part of the video, and that's fantastic as well. That's a big help, just even watching the video. So big thanks to you. And we'll see you next time. So